Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront, and generate consistent returns year on year. So the first thing you want to do is open up your brokerage platform. We've got a futures position on the Canadian dollar right now, but we want to navigate to a equities underlying. Any equity will do, it doesn't matter which one you choose. We've got BA open right now, and we want to then navigate over to where we can see a list of expiration dates for the underlying. And at this point, we simply want to pick an expiration date that we're going to use moving forwards to mock up our positions. Now, the one that we lock in on, or the expiration date that we choose, needs to be between 30 and 60 days out in time. It also needs to be a weekly and not a monthly expiration date. So the only one that actually fits that criteria right now is January 17th, with 36 days left on the contract. So now we know that information, we can come over to our watch list and we can filter out any and all underlyings that have earnings over the next 36 days. Earnings will increase volatility. It will almost certainly mess up our deltas after the actual earnings announcement. And both of these things will have a negative effect on our P&L. And we also want to filter out anything that has a low liquidity rating level. The reason for this is because we only want to be trading things with liquid markets so that we can get in and out of positions easily, and so that we're only paying tight spreads, not wide spreads. Just remember, more liquidity, the tighter the spreads, the less it's going to cost you to get in and out, basically, of positions. So this is a futures watch list. We're not going to go over futures. We're just going to pull up any watch list. This is just a pre-made watch list that we've got open here. And we simply want to go through the watch list and see if there's anything that actually fits our criteria, or if there's anything that looks nice to add to our portfolio. So keep in mind what's already in your portfolio. Make sure everything is nice and diverse. I've got this watch list ordered from high to low IVR. We want to be selling premium or selling contracts when volatility is high. Volatility is mean reverting, so you want to sell it when it's high and then play the contraction back down to the mean, hopefully further below. IV rank is a metric that we can use to determine whether volatility is, or implied volatility is, high or low on that specific underlying relative to itself. So with that in mind, you want to see what the actual size of the underlying is, right? How much it's trading for. If it's too small, you won't be able to find positions. If it's too big, I'm going to show you how you can turn big positions into small positions. So just make sure it's not too small. You can use beta weighting, you can use correlations to SPY, whatever, if you want to for diversification purposes. But as long as you use common sense, for the most part, you'll be fine. And you also want to look at the absolute IV level as well, because that does play a part too, and that is different to IV rank. So keep that in mind. So just going down the list here, I'm looking at mRNA. mRNA seems to be looking quite nice. It's trading at just under $43. It's got an IV rank of 84.3. If we just have a look at the chart here, as you can see, this is IVR, and IVR does seem to be elevated here. So this could be a position that we look at. CE here, it's got an IV rank of 75, an absolute IV level of 44. However, with mRNA, you've got an absolute IV level of 86. More doesn't always mean better. It really just kind of depends on what's happening in the market and on what's typical for that specific underlying. For example, you got Tesla here, with an IV of 68%, over 68%, which is not too far out of the ordinary for Tesla. So a bit of market awareness needs to come into play, but you'll develop that over time naturally. We've got UAL here. If you just have a look at the chart for UAL, UAL made a massive run up. It seems to have slowed down at around about $100 per share. Let's see what else we've got. Palantir with an IV rank of 62. this could be a nice position as well. But let's just have a look at mRNA with an IV rank of 84.3. This could be a nice trade here. So we want to pull up the list of expiration dates, and we've now already locked in on the date that we're going to choose, which is January 17th. And at this point, we simply just want to sell one call and sell one put. So we could sell a call at the 22 delta. You want to pick strikes that are between about 15 and 20 deltas. Obviously, strike selection isn't the best for mRNA. It is a underlying that is slightly on the smaller side. This is why you want to make sure that your underlyings are trading at say $50 and above. 42 could be okay. I mean, it's not bad. It's not the worst. If we couldn't get the strikes that we wanted, then we just have to move on. But generally speaking, $50 plus, you'll be all right. Make sure it's nice and liquid, and you'll get some decent strikes. So 21 delta here, and you've got a 19 delta over here. And this is basically it. This is the position. We've got a 70. We've got between a 70 and 80-85% chance of success. As long as price stays within this range here between 35 and 55, at expiration we get to keep 100% of the premium that we collect up front, which is $256. $2.56 times by a contract multiplier of 100 shares per contract. That's how we get to $256. So we collect that up front. It's non-refundable. No one can take that away from us. And our broker is going to require just under 1.8k in buying power to open this position. Now, 1.8k might be a bit too much for some people, although this is a nice return on capital, $256 for 1.8k. However, 1.8k just might be too much. So what you can do is just buy another contract a little bit further out, like so. And what that's going to do is that's going to reduce the amount of buying power that's required, because our buying power is no longer on a naked position. The amount of buying power that's required, where it comes from is basically it's your broker is there is a fixed formula, but in a nutshell, it's your broker making sure that they hold enough money from your account in order to cover the worst case scenario. That's what the buying power is. That's where it comes from. If you look at your CVAR is around 1.6k, your buying power is around 1.8k. CVAR is conditional value of risk. It's basically this is what you'll be looking at in the worst 5% of cases, right? But if we buy our long contracts to cover our short contracts, we no longer have an unlimited loss potential. Our max risk is now known. It's not undefined, it's defined. We know it's $5, which is 60 minus 55, 35 minus 30 is $5, right? Minus the premium that we collect up front, which is 1.39. You times by what's left by 100, because that's a contract multiplier, and that's how you get to your max loss of $359. So your conditional value of risk now is $359. Your max loss is $359. Your broker only needs to hold $359 because in the worst case scenario, you can only lose $359. So you have a much higher return on capital. You bring the buying power requirement right the way down. And the trade-off is that you have slightly lower probabilities of success. So that's how you can find and manipulate positions to fit inside your portfolio. If you want to know, how much buying power you should be allocating to your positions, click the link in the description. Click on free position sizing template, and it will bring you to the spreadsheet. The way it works is you enter in the size of your portfolio, and then you enter in what the current VIX level is, and everything below will then be automatically calculated for you. And as long as you use this information to form the backbone of your portfolio, you'll be absolutely fine over the long term. It will tell you the maximum amount of buying power you should be allocating to any single defined risk position, undefined risk position, and how much of your portfolio you should be allocating to short premium strategies in general. Because if you've got, say, $10,000, in this case, if you've got $15,000, you should not be allocating all $15,000 to selling premium. That would be silly, and you wouldn't want to do that. And you don't need to do that to generate healthy returns. But yeah, follow this and you'll be fine. If you want to learn in more detail and what we do and how we do it, again, link in description. This time, click on EDS Premium, get yourself signed up. Inside, you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, how we're making adjustments, all in real time. There's a full course as well, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It's a private community, so if you get stuck, you can speak with myself directly or with other like-minded individuals. There's a 100% money-back guarantee. So if you have studied the full course and followed our trades for at least 6 months, at that point, if you haven't seen results or aren't profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free on your part. It's £1 a month to join right now. The price will be increasing. However, once you're in, the price is locked in for you for life, so you have nothing to worry about. And the aim here is after 6 to 12 months, you should be completely self-sufficient. You wouldn't need to rely on us. By all means, you're more than welcome to stay and be a part of the community. However, it's not necessary. The mission here isn't to get you to pay us £1 a month indefinitely forever. 6 to 12 months, and you should know how to do this yourself without any outside help or influence for the rest of your life. So with that being said, I will see you guys on the inside.